Last year I did 5.5 million in sales with 7 guys in the field. I'm gonna show you how I motivated them to be productive. Spoiler alert, it was through performance pay. In this video, I'm gonna cover how I paid my technicians, the guys out in the field, how I paid my CSRs, the ladies in the phone the ladies in the office answering the phone, and how I paid my general manager, all on a performance pay structure to keep everybody motivated and performing at their highest level. So first thing we have to understand are the 2 goals of a performance pay structure. Number 1, we want to incentivize performance in our employees. And number 2, we want to control our labor costs. If you put the wrong performance pay structure in place, your labor costs are going to skyrocket. If you just pay your employees hourly, they have no reason to be productive and your labor costs will skyrocket. So it does both things for you. It controls labor costs for the company and it also allows your employees to be productive and make more money. So before we get started, we really need to dive into how this plays out on your profit and loss statement. Again, if you're new to this channel, you're going to see me mention this a lot because your profit and loss statement is the report card of how well your business is doing. And one of the things that kills people on their profit and loss are high labor costs. This is how we control them. When you're looking at your P&L, you have total income. That's always 100%. And then underneath that, you have your COGS. You subtract your COGS out of your total income, and that gives you your gross profit. COGS for any service business, home service business, electricians, plumbers, HVAC, pressure washing companies, anything where you're going to a homeowner's house and you're providing a service for them, your COGS are labor and materials. Some of you will have subcontractors. For this video, we're not going to include that in there. Typically, we want to keep our labor costs below 25%. This will vary from industry to industry. You need to track it on your P&L to see what it normally is for you and how we can get it down lower. Materials for my plumbing and heating business, since this is the business we're talking about, we're about 20%. Now remember, we take our total income and we minus our COGS, and that gives us our gross profit. In this case, it would be 100% minus 25% minus 20% for a 55% gross profit. That leaves me 30% for overhead and 25% for net profit. When I go to price my services, I use 55% gross profit as the desired margin that I want to hit. So based on this, I know that I need to keep my labor costs below 25%. My direct field labor costs need to be below 25%. How do I do that? That's where performance pay comes in. So for our technicians out in the field, our plumbers, our HVAC guys, this is how we structured their pay. We used a system of base pay plus commission. Their base pay was $50 an hour plus benefits. Their commission was 10%. But in order to get this commission, they had to hit a certain revenue threshold for the week. We paid them every Friday and we would go in, they would get $50 for every hour they worked. Overtime was time and a half. And then they would get 10% on anything over the revenue threshold. So how do we figure out what that revenue threshold is? And why do we need to figure it out? If we paid them $50 an hour plus 10% commission on any revenue, then what's going to happen is our labor costs are going to be way too high. Here's an example. We'll math it out. Let's say this technician did $5,000 in revenue. And at $50 an hour, 50 times 40, his paycheck would have been $2,000 times 1.1. We're going to add some taxes in there, 10% taxes. His paycheck would have been $2,200 plus he would have made 10% commission on this $5,000, which would have been another $500. So his total paycheck would have been $2,700. If we do the math, compared to how much revenue he brought in, $2,700 divided by $5,000 is 54%. More than double the labor costs that we want. So when we structured this commission pay, we said, okay, how much revenue do my technicians need to bring in before they can get a commission where labor costs stay below 25%. What we actually did is we actually went back and said, okay, 5% of our labor costs are going to go to employer taxes, healthcare, and 401k plans. So we want to keep these direct labor costs below 20%. So here's how that math worked out. If our technician brought in $12,000 in 1 week and he made $2,500 on his paycheck, $2,700 on his paycheck, that puts his labor costs at 22%. If he brings in $13,000, that puts his labor costs, at 20%. So now we know whenever they bring in $13,000, we can give them 10% commission on anything above $13,000. So if a technician brought in 26 grand 1 week, which is not uncommon for my guys to do, they would get paid their base wage. That would cost the company $2,700, plus they would get 10% commission on $13,000. So they would make an extra $1,300 on their paycheck. Their total paycheck amount with taxes included would be $4,000. Okay? You can see how this will motivate your guys, number one, to hit the minimum, and then number two, to go above and beyond that to make as much money as possible. What I love about this is it controls labor costs, number one, so it'll keep those labor costs 25% lower, but it also gives the technicians a threshold to hit. So there's some built-in accountability to this structure here. If you're not hitting $13,000 a week, then you're costing me too much money to be working in my company, and we got to get somebody else in that seat. So when you get hired on at my plumbing and heating company, which I don't own anymore, so it's kind of weird to talk about, but we're going to tell you right away, hey, look, you got 90 days to be producing at this level. This is the level we need you to produce at. Everybody at this company produces at this level. We need $13,000 a week on average from you, and we need your customer satisfaction to be at least 4.8 or higher. In fact, if you produce more than this, we start to give you a 10% cut on any revenue you produce over this. And we provide them with a spreadsheet that shows them exactly how much money they can make for how much money they bring in. So what that looks like is it says $13,000, here's what your paycheck looks like. Here's what your commission looks like. $14,000, here's what your paycheck looks like. Here's what your commission looks like. $15,000, here's your paycheck, here's your commission. So we can show them, if you bring in 20 grand, here's how much more commission you make. Okay. Now, when you structure this on their paycheck, you need to make sure and pay them this commission right here. State laws in most places, you have to pay for people out in the field. You have to pay overtime on this money. So it's a math equation of how you calculate it. If this person worked 45 hours to make this happen, technically you need to pay overtime on this. It's math on how you do it. Make sure your CPA is doing it correctly, because if you just pay straight commission on it, you might get busted. So that's how we paid our technicians. What about our general manager? Okay, our general manager, he got bonused off of gross profit, that number right there. The general manager has direct control of your labor and your materials. So to bonus him off of what he has control of makes total sense. If he can get gross profit from 55% up to 60%, that extra 5%, as long as you, the business owner, are controlling your overhead costs, which typically stay pretty static, that extra 5% will jump straight to the bottom line net profit. So it makes a lot of sense to bonus your managers off of gross profit and encourage them to get that as high as possible by controlling labor costs and material costs. The way he's able to control labor and material costs is through efficiency, okay? if we can use our labor more efficiently or buy materials more efficiently, we bring in more income, which lowers these costs as a percentage. We might spend more dollar amounts on our labor, but compared to how much income we bring in, the percentage will go down. That's what you want your general manager to do. He is there operating the machine at peak efficiency, driving gross profit as high as humanly possible. You as the business owner are controlling overhead costs and creating as much net profit on the bottom line as possible. So what does that look like? Well, general manager, let's say he makes $100,000 a year salary plus benefits. And we know that our desired gross margin is 55%. And quarter one, at your company, he brought in $1 million top line revenue. Let's see, 1 million. And let's say he did a really good job this month and he got labor costs down to 20%. So that'd be $200,000. And he got material costs down to 15%. So that'd be 150 grand, okay? 1 million minus 200,000 minus 150 is a gross profit of 650,000 or 65%. So he would get a commission on anything over 55% gross. So there's an extra $100,000 there. So what we did is we gave him 20% bonus on anything over 55%. So he would get a $20,000 bonus at the end of quarter one for getting $100,000 over our desired gross margin. That's a lot of money. If he can do that every single quarter, you just upped his wages to $180,000 a year, which is a good salary. But for you, the business owner as well, you just dropped an extra $75,000 to the bottom line over quarter one, or $25,000 every single month. And so typically you would do this by department. You would have a service department manager. You would have a install department manager. If you have electrical, you'd have an electrical department manager, and they would all get bonused based on their department's top line revenue minus their department's COGS and how much over they went above and beyond your desired gross margin. So that's how we paid our GMs. Now let's talk about how we paid our CSRs. Our CSR pay was relatively simple. We paid them hourly. You're kind of getting the gist here. Everybody kind of gets the same pay scale. They got paid hourly plus a bonus, but we bonused them in a slightly unique way. Let me explain. We know that as a company, for my company, Prospector Plumbing and Heating in Fairbanks, Alaska, we needed to pull in $361,000 every single, I don't know what that is, every single month, MO for month, in order to break even. So that was our break even rate. What happened once we hit $361,000 in revenue for the month, we had our CSRs go back and start calling all of our unsold estimates. So you can imagine, this would typically take us 2.5, 3 weeks to hit our break even. So now we have a week and a half to a week left in the end of the month. Everything after this break even is pure profit, okay? So we would have our CSRs go call all of our unsold estimates, even from the month before. If we had big estimates out there, we would go call them. They would call through all of those unsold estimates and they would offer them a 15% discount if they would book that job and get it done before the end of the month. A lot of times that 15% discount is the thing that customer needs to push them over the edge to get this work done. And if you think about it, once we hit this break even, all of our labor is covered. So all of our 20% labor costs, 25% labor costs covered. All of our overhead is paid for. Okay, so there's an extra 50, that'd be 30 plus 25. There's an extra 55% margin that you can play with on these jobs. So we would discount 15% and we would still be at 40% net margin on these jobs. So what we did is we said, okay, how do we get these CSRs to want to call up and follow up on these estimates? Well, we started paying them a 5% commission or bonus on any jobs that they converted. And we were still at a 40% net profit on any of the jobs that they converted. Now, this worked really well to get the CSRs to want to go find the most profitable, the largest estimates, and call these customers like crazy to see if they can get them converted, because they can make a pretty decent paycheck. If we've got, $30,000 boiler install job or a $20,000 dig up and sewer replacement job, that 5% extra on their paycheck, if they convert a couple of those, ends up being quite a bit of money. The other unintended consequence of this is that the CSRs understood that if they work with the technicians in the first few weeks of the month to get them the best jobs, make sure they're using their talents appropriately, and make sure they keep them happy and motivated, they're gonna hit this $361,000 minimum faster, which is gonna allow the CSRs more time to go call through more unsold estimates and convert more of them and get a 5% commission. This also had an unintended consequence with our technicians. The technicians knew that as soon as we hit this $361,000 break-even number, the CSRs are going to go back and call unsold estimates and sell work for them. On the technicians end, you got to remember, they've already been to this house, they already talked to the customer, they already built the estimates, and the customer didn't want any work done. So if the CSR can convert that job, the technician, when he goes back, he's already got the estimate done, he's already talked to the customer, he already knows what parts list he needs, he already has pictures. All he has to do is go get the parts and go do the work and bring in the income, which helps him produce more revenue at the end of the month. And if he gets over that $13,000 mark, he gets 10% commission on anything over that. And so a lot of the times we're converting $10,000, $20,000, $30,000 jobs, and these technicians can make a pretty big commission at the end of the month. So knowing that these CSRs are going to go call back unsold estimates, they started playing really nice with our CSRs. I didn't see this coming, but it was a great unintended consequence. And the lesson that I learned is that anytime you make a decision in business, there's always the intended consequence that hopefully happens, and then there's unintended consequences. Some of them are good and some of them are bad. And you don't know what's going to happen until you make the decision and measure it and see what happens. A lot of business owners are afraid to change. And what I've learned is that change and continually changing and pushing forward and progressing forward is the key to a successful business. So there you go. If you guys have any questions, drop them in the comments. We'll make videos to answer your questions. Hope you enjoyed this one. See you on the next one.